Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, UK rate strategist, and I'm joined today by our global market specialists, Giles Gale and Jan Nevruzi. I can't believe I'm saying this, but it feels like a little bit of a quieter week this week after the last few months that we've had, although I did remark to Giles that gilts were very volatile yesterday, and he told me they've been very volatile for about the last 3 months. So he really put me on my place. But let's start with Europe, as I think that's maybe been the slightly more interesting week this week. We've obviously had Sintra, the ECB's forum on central banking, and we've had data. So let's start with the data. We had European kind of national inflation prints this week. I guess the most headline grabbing of those was Germany yesterday. We're recording this on Thursday as a reminder to our listeners. So that was yesterday. Germany came with a big downside surprise, but then it was kind of been a bit more mixed in other countries. We had Spain that didn't surprise to the downside. So what do you make of these inflation prints, Giles?
Well, to be honest with you, not, it seems, quite as much as the market has, because you were talking about the market volatility just now, and I mean today again it's off to the races, and we're rallying, what is it, 15 basis points or something like that in bonds, more in the long end. It just seems like that every day, and that's on the back of a similar move yesterday as a result of those inflation figures. I think it was always clear that in a reasonably light data calendar globally, that these preliminary CPIs coming out of Europe, with the reaction to the downside surprise in the UK, when was that, last week, I suppose, in mind, that was potentially the key release at the global level. And of course, Germany, as you say, came out on the low side, and there was a little bit of a reaction to that. It turns out that actually, if we had all been paying closer attention, it was mostly because there was some technical things around price limits that have been put in place, temporary price limits just over the summer months on transportation. Nonetheless, and then that wasn't corroborated by the Spanish figures, and the French figures have since come out sort of more or less in line with where people thought they were going to be. Now, I think a couple of things just to keep in mind. Most economists, ours included, think that inflation is going to peak later this year, and certainly on the headline figures, and that still seems like it's on track. So just keep that in mind when you're interpreting the figures in the short term. But at the same time, there will be more pushback from government. I mean, so this, we shouldn't entirely view this German thing as a one-off, because government will be trying to target some of their fiscal measures more and more towards trying to moderate some of the more outsized price rises that you're seeing around the place. So that is a little bit of a risk. Doesn't mean the inflation pressures may necessarily go away, but it might address in a very small way some of the concerns about second round effects, which is really what we're going to be watching in the labour market data when the summer's over.
So speaking of second round effects then, and the labour market data, that was obviously a big topic of conversation at this week's Sintra conference, the ECB's forum of central banking. I guess the main event was yesterday's panel that had Lagarde, Bailey and Powell speaking at it. So I've got a pretty repetitive question to ask all of us at this week's pod, but I guess since we're on Europe, I'll start with you. Did we learn anything new from Sintra this week? It has been used in the past as a forum, I suppose, to announce kind of policy changes or signal that policy changes are coming. Did we get any kind of signal or learn anything new from this week's panel discussions?
You mean the panel discussion with Andrew, Agustin, Christine and Jay? Well, honestly, no, I don't really. I mean, okay, so I don't. From my perspective, not a great deal actually. I think I took Christine Lagarde's speech that kicked off the conference as moderately hawkish, to be honest with you, just in terms of the emphasis that she chose to give to things, which seemed to follow the emphasis from the June ECB meeting, which now 2 weeks ago seems like 2 weeks ago seems like an age, given what's happened in the intervening period. And clearly the market has gone fully from hawkish central banks, inflation risks, to when's the recession? And it doesn't seem like central banks have quite made that pivot in real time in the same way.
That markets are fickle, Giles?
Not markets fickle, I don't know. I mean, maybe central banks are just they have too much inertia. I don't know. I mean, to be honest with you, the markets have been leading central banks for a year and a half, and it may well stay that way. I think it's just worth highlighting that it didn't. There was no real evidence, to me anyway, that they're watching the markets going, actually, there's a point there. There's something that we need to talk about. At the same time, I mean, before Sintra, there was the BIS annual report and sort of some communication around that. Agustin Carstens was on the panel as well. The BIS is inveterately hawkish and always worries about inflation. That this time was no different. Now that didn't really shine through particularly strongly in the panel either. I didn't feel, but regardless, my basic answer is think whatever you were thinking.
All right, fair enough. So putting that together then, we've talked about long discussions about what you think about the ECB before, and obviously that hasn't changed this week then. The kind of new news in terms of the data and market sentiment, how does that, come together in terms of your market views? Readers of what we publish on Agile Markets will know that you were recommending strongly going long the front end of European rates last week. It's a good day to be discussing that, because I think as we talked, they're about 20 basis, or 2-year Germany at least is about 20 basis points lower on the day. And you've kind of been tempering your bearish conviction, let's say, further out the curve. So I'm guessing those views still hold.
Yes, I mean, things move very quickly, don't they? And it's difficult to be maximum conviction when you've just had a move in your direction of the size that we've had. I think in 10-year bunds, actually, I'm sort of leaning a little bit more bearish now after the move that we've had. It's that sort of environment at the moment. I mean, it just seems like every move is a potential overshoot. I do think there's still some value in the front end, though.
Okay. And just to finish up the discussion on Europe, then what about in periphery? There's been a lot of headlines this week, and little news, as you say, from Sintra, but a lot of headlines around what an anti-fragmentation tool might look like, how they might use reinvestments flexibly, etc., etc. I know we talked about this briefly last week, but do you have any kind of high convictions there in periphery spreads?
Well, yes, still long periphery, which I think we talked about last week, because I have a vague recollection that I was talking about the positive seasonals for Italy going into July, and that on top of the expectation of some pushback against this volatility and potentially against the level of spread as well from the ECB, it seemed like the reasons to be bearish, you had to have some pretty good reasons, and I didn't have any in the short term, and so you might as well be long. I maintain that, to be honest with you. It's moved in the right direction, and I think with only moderate conviction that can probably continue. We were told that the purchases associated with the kind of flexibility, this use of flexibility within reinvestments in the PEP and the PSPP would start as of tomorrow. Let's see if that happens. To be honest with you, base case is that it doesn't necessarily have to happen. We don't, and at the same time, on the OMT2, this anti-fragmentation tool, there's nothing new. It seems like, well, the consensus is, well, I think we've already talked about it. We don't have to go into that today.
All right, we can talk about it much more as well when we get closer to the July meeting. Okay, sticking with central banks then, while we're on the theme, Jan, over to you on Sintra. As I already mentioned, we obviously had Powell on the same panel. I guess that was the kind of main central banking event this week. So can you just give us a quick roundup of what your takeaway was from a US rates perspective, if there was anything really to talk about when it came to Sintra this week?
I think there was stuff to talk about more than the standard, we will control inflation, don't worry about it, we got this, don't worry about how it's going to happen type of conversation. I think the added level of information that I personally got, or at least kind of like the feeling from the US side, was that it felt a little bit more downbeat on growth, or at least the potential impact on aggregate demand of the Fed's tightening. So they're willing to control inflation, and there were statements such as overshooting or like overdoing on the growth side is not our worry. If not controlling inflation is our number one worry. It might cause a lot of, or it might cause some pain. They're going to get it under control no matter what. So there's definitely the focus is shifting a lot to inflation will come down and growth might come down too. So it's just pretty much, the idea is to pull both demand and supply down and just hope that inflation moderates in the process. And they've acknowledged it. There was also a little bit kind of almost philosophical, what we know is that we don't know much about inflation, which is not really reassuring to markets. But combination of those things took at least fixed income markets and just ended up in a pretty powerful rally, mostly based on expectations that central banks or the Fed in this case will be able to trample inflation, initially felt in break-even rates, and later on more so in real yields, as well as fears of kind of recession start kicking in, because that was more of the dynamic that I got. That being said, I was looking to hear a little bit more on the University of Michigan survey, which they mentioned as the reason why they upscaled to 75 basis points, or at least Powell had, and I didn't. The same logic should have applied in reverse. If they use in kind of exposed to explain why they hiked 75 basis points, saying the consumer. So the University of Michigan has a component that asks consumers about their inflation expectations, and that moved higher. And Chair Powell said, that's the reason why, one of the reasons why we upscaled our kind of like a hike base. So that got revised lower afterwards, and that wasn't addressed. So the same logic should have applied in reverse, but it didn't. Anyways, nothing on that. It was mostly on the growth side that I got the kind of like the new added information for, and bond markets did as well.
Okay, so moving on to the data side of things then, because today we've also had, PCE data. We often think of the kind of core PCE inflation as being the Fed's preferred gauge of inflation, I suppose. That showed a decrease in May. So not only a kind of month-on-month decrease, but also came below expectations. What do you make of that, and where does that leave the Fed from here?
I think three really key points from the PC number today. One, like you mentioned, of course, the drop is a good thing. It's going to be reassuring for the Fed. Coming below expectations is a good thing, and markets priced out some Fed action on the back of that too. So that's number one. Number two, there is a growing discrepancy between the PCE number and the inflation number, the CPI inflation number, which also gets perhaps grabs even more headlines, even though the Fed prefers to use the PCE, as it tends to more dynamically adjust and reflect the spending patterns of the consumer much better. Nevertheless, they can't just ignore or like a much higher levels in the CPI and just stick strictly to the PCE. But that growing wedge between the two will be an important topic to watch. or at least how the Fed handles that will be something important to watch. And the final thing, moving away from the inflation side, but also the spending side, spending was a lot less than expected. However, I have to point out a lot of the drop came from both in nominal and real terms from goods spending, so non-durables and durable goods both fell. On the other hand, services spending still remains fairly strong, which has also been the recent driver of underlying driver of inflation. So I wouldn't really go ahead and dismiss and say we're out of the danger now, but there is a little bit of at least some temporary relief for the Fed with like a lower print. I don't think it's going to change the course or anything, but if anything, gives them confidence to maintain and that things are looking a little bit better.
Okay, so I guess, again, same question to you as I posed to Giles. I'm putting that together, what we heard from Powell this week, what we've now starting to see increasingly in the data. Where does that leave your view on markets? I suppose we've spoken about this a couple of times, and you keep telling me it's too volatile to have high amount of conviction. And I feel like Giles was telling me a similar message, but you've been calling kind of peak hawkishness in the Fed for a while. It seems like that view is playing out. Where do you think rates go from here, or is that not the best way to play this view?
So rates have rallied a lot over the last few days too, and especially since the last time we recorded this. But our view was of lower, even though we, because of the whole sell-off in rates post CPI, post Fed, we kind of had to stop out of our long recommendation. But we have our forecast that we publish, and readers and listeners generally know our long bias, like you mentioned about the peak hawkishness. So that hasn't changed, and I think yield levels are looking a little bit closer to where I think they would end the year for the 10-year at least. Maybe a composition will be a little bit different between inflation part and the real yield side, but 3% or kind of that range is where is our medium term view. Tactically, it's kind of hard to again have that directional view, but on the back of that, like you said, we've been talking about the high levels of volatility, and we had a high levels of realized volatility, but behind it left high levels of implied volatility. So now those have been coming off a decent amount post PC, post these rallies, as the outcome of possible distribution narrows. But I still think there is kind of value in selling that type of optionality, particularly in the short end of the curve. So things like we're discussing one year type of trades where we just see a comfortable range of scenarios where the option would still fail to be in the money. In the way that we see the Fed can get a little bit more hawkish or maintain course. They really can slow down that much, because there are still inflationary pressures. So they're going to have to maintain at least some level of above neutral rate is in our expectations, while it still fits with the whole peak hawkishness theme. So selling optionality makes sense. Meanwhile, we'll be looking for retracements in outright yields in the longer part of the curve to see if it tactically makes sense to go long or short.
Okay, so I guess now it's the time for the very same question for you, Imogen, since Bailey also participated in the same panel as Lagarde and Powell, Christine and Jay, as they like to call each other. Anything of note for the UK in that discussion?
Honestly, not hugely, I don't think. Bailey sounded pretty cautious on the economy and the risks facing the UK economy in the next couple of months. He was very clear that their assessment was that the UK data was turning, and that markets, as you kind of put, Giles, were now grappling with that theme. He was clear that he saw risks to the UK as being greater than in other countries, that the UK had started to weaken earlier and perhaps faster than other places. He was very particularly generally cautious on how, the sort of lower half of the income distribution was going to be hit in this cost of living shock, and what that might mean for growth in the UK. So on the economy, very cautious, but not necessarily more so, I don't think, than we've already heard from him before. He's been very clear about how he sees recessionary risks in the future in the UK, and he's repeated a number of times that the Bank of England is treading this fine line between bringing down inflation, but also balancing, not tipping the economy over into recession. Markets have largely chosen to ignore those kind of warning signs from him before. So perhaps this is the first time that they maybe listened to him a little bit more. But I wouldn't have said that was kind of new rhetoric coming from him. He obviously, talked about high inflation and how he saw upside risks. But again, I don't think that was new. And it's probably worth noting at this point that the Bank of England had already revised up their inflation forecast back in May, and the data so far is really tracking in line with those revised up forecasts. So it's no worse than they expected in their kind of baseline scenarios. And don't forget, in those baseline scenarios, with the bank rate that the market is pricing in, they have inflation significantly below their forecasts over the 3-year horizon. So this doesn't change, I don't think, the fact that they're signaling that markets are still pricing in too much when it comes to bank rate expectations. With regard to the change in the language, how they took away that sentence around some further tightening may well be required, and they replaced it with this sentence that they could act forcefully if needed. Markets interpreted that initially, when it was first published at the June meeting, as very hawkish. They again sort of ignored the conditionality that was attached to that sentence. And yesterday, Bailey was quite clear that all options are on the table. Yes, they can hike rates faster and higher if necessary, but it's very much conditional on this being necessary. And he said, this isn't just about rate rises. Everything is on the table now, and they will be very data dependent. Asked about whether he saw or whether he would be voting for 50 basis points in the August meeting, he was very clear that he would, be watching the data over the next couple of weeks, and it was much too early to come to any conclusion on that. I guess just to round off the discussion on Sintra, as we spoke about last week and has been a big driver of our change in gilt view, we do think that the data is now turning. And so to the extent that they're closely watching the data over the next 6 weeks or however long we have left, we expect this to weaken. Perhaps more interesting, though, this week, I think, out of the Bank of England was that we heard for the first time from Saunders' replacement on the MPC. The headline sounded significantly more dovish than he is, although it's, I guess, would have been hard to imagine a more hawkish member, but it does seem at the moment like he's going to be replaced by someone much more dovish. And he is one of the 3 that has voted in the last 2 meetings for 50 basis point hikes. So that does change the skew of risks, I think, on the MPC at the margin, although, of course, he will still be voting in the August meeting, but then not after that.
Yeah, okay, fine. So I guess as a follow-on from that, you changed your view on rates last week, as we discussed, now seeing lower rates in the UK. And now I suppose, given what you've just said, perhaps your conviction on that should be strengthened?
Yeah, well, definitely not weakened, I don't think. As you said, we revised our view on UK rates to be bullish last week, so we expected yields to go lower. We revised down our target to 215, so obviously in these markets, that seems like just one day's move now, but I reckon we're probably still 15-ish basis points away from that. So we still have high conviction in that bullish view. We still think, although markets have repriced some bank rate expectation, there's much further to go. The data is turning, we think. As we spoke about last week, seasonals are supportive for gilts in the very near term. So yeah, we do still think there's further to go. I mean, as you mentioned, these are super volatile markets, and they can move towards your target within a day, which obviously lessens your conviction a little bit the closer you get there. But we do still think that there is at least about 15 or 20 basis points of juice in that kind of long 10-year gilt trade.
Okay. I suppose we've covered in great depth the front end view and the central bank sort of led view. But what about the longer end? Because last week we had a syndication at the long end, and that's provoked a lot of discussion. Perhaps you can just summarize that for us a little bit.
Okay, well, I'm hoping that we might do a bit more of a deeper dive podcast on this. This is a little bit of a teaser to our listeners to come back maybe next week, or at least in the next couple of weeks, that we'll be looking at this much more closely with our kind of pensions experts in-house. So this is just a sort of teaser for that conversation, because we have been looking at this, as you know, Giles, much more closely this week, particularly in light of this syndication last week. And for those that aren't so close to the gilt market, essentially there was a long end syndication last week, and the allocations towards LDI, who usually are thought of as having very strong structural demand for long end gilts, was much smaller than it has been in recent history, and that triggered, I think, a lot of discussion around whether that was a structural change in shift in demand, and that LDI actually weren't going to be such big players at the long end of the gilt market anymore. So we've been looking at this in detail and trying to come to some conclusions about the structural short and whether or not it still exists. I think our conclusion is that it's nowhere near as big as it once was, and in fact the structural short that does still exist, or much smaller than it has been in recent years, we think can even shrink pretty rapidly over the coming years as gilt supply grows. We've discussed the kind of upside risks on the supply side for a long time in this podcast, but it's not just about the supply risks. Of course, you also have QT selling, which adds even more upside risks, and that structural short on the liability side, as pension liabilities at least stagnate, if not shrink from here, can shrink as well. I don't think that means that pension funds or pension schemes won't have demand for the longer end of the curve, but perhaps does mean that where we once thought of their demand as being a significant downward force on yields, it's more of just a cap on how much further they can go, really. And probably, in a higher rate environment, they're still likely to have some longer end demand, but it's likely to be reactive to those shifts higher in yields rather than proactive. And so actually this kind of structural force of demand, which is perhaps kept you away from sort of recommending steepness or being bearish the longer end of the curve, is shifting. But like I say, I think that's a much bigger discussion, and one that we can go into in much more depth with our pensions experts. And I think we plan to do that on a podcast in the future.
Sounds absolutely fascinating. I will definitely be I'll definitely be tuning into that. Okay, well, in that case, I think that's all we have time for today. Thank you everyone for listening or watching, and I'd just like to remind you that if you like today's episode, please hit the like button to show your appreciation, and click subscribe so that you can listen to our latest episodes as soon as they're available. Thanks again, and see you next week.